Good morning. We shall today learn concepts related to salary in terms of what constitutes salary, how deductions shall be given on salary along with other income under section 80C and tax calculation both as per the old regime and as per the new regime. So before we talk of concepts related to salary, there are certain things that we need to know. The first point that must be borne in mind is that when we are talking of salary, we are talking of relationship between the payer and the pay as that of the employer and the employee. So where a person gets any kind of payment from a person other than employer, that would be taxable not as salary but maybe from some other source. For instance, it could be house property, it could be capital gain, it could be other sources. But if the relationship between the employer and employee exists, very commonly we find this situation in case of gifts. Gift from an employer would be income from salary, but gift from a person other than an employer would be income from other sources. So it's important that we maintain the relationship between employer and employee. Between salary and wages, we normally do not make any distinction, though conceptually salary is paid for non-manual work and wages are paid for manual work. But for computational purposes, salary and wages are considered to be the same. You may receive salary from more than one source as also from more than one employer. So together for the entire year, if we are receiving salary from more than two employers, then one of them would give Form 16 as the proof of your income from salary, and the entire salary together will be considered for tax purposes. Foregoing of salary. Now, between foregoing of salary and surrender of salary, the difference lies in its taxability in the sense that salary foregone is the right of the employee. So, if you receive salary and after receiving you forego a part of it, let's say you receive a lakh of rupees and you forego 10,000 out of that, then you will be liable to be taxed on 1 lakh. But if you surrender, you lose the right to receive the amount that you have surrendered in favor of the third person. And therefore, if you have received 90,000 out of 1 lakh, your tax liability would lie on 90,000 and not 1 lakh. Then we have the concept of tax-free salary, which is commonly mistaken as salary which is exempt from tax. Tax-free salary is not exempted salary. Tax-free salary means net salary, that is salary after deduction of tax. An employee X receives a salary of 10 lakhs on which tax has been deducted to the tune of 2 lakhs. So technically he receives 8 lakhs, but for computational purposes this 8 lakhs has to be grossed up by adding back 2 lakhs to that 8 lakhs. So his gross salary, and for all percentages that we have to calculate on the basic salary, that would be 8 lakhs plus 2 lakhs, that is 10 lakhs. Now we need to know, after the basic introduction to salary, what are the components of salary? Salary includes basic, it includes allowances, perquisites, leave salary, gratuity, pension, employer's contribution to recognized provident fund, and interest credited to recognized provident fund. Various types of provident funds. When we talk of employer's contribution, It is only recognized provident fund that one has to be careful about, because beyond a certain percentage, both employer's contribution and interest on that is considered to be part of the taxable salary. Together, whatever an employee receives out of all these components, naturally you don't receive all of them, of whatever you receive out of these, we add them and arrive at the figure of gross salary. But for tax purposes, for computing the gross total income, which is the sum of 5 heads of income, the first head of income that we are discussing, salary, it is not the gross salary that is taken as a part of gross total income, but net salary. And net salary is your gross salary minus certain deductions. We give 3 deductions on gross salary. 1, standard, it's a fixed amount. 2, entertainment allowance, it's based on a computational rule. And 3, professional tax paid by the employee. We'll discuss this later once we are done with the computation of gross salary. So when we arrive at net salary, it is the net salary which now becomes a part of gross total income. Now the first component, basic salary. Now basic salary is naturally salary for the current previous year that we are studying. It also includes advance salary that you have received for the next year. Why? Because the basis of charge of salary is due or received, whichever is earlier. So advance salary becomes due next year when you actually work, but since you have received it now, it will be taxable in this year only. So advance will be taxable. Any areas that you have received with respect to earlier years would also be taxable this year. So we have 3 things. 1, advance. 2, arrears. And 3, the salary that you're receiving for the running year. When we have the basis of charge of the salary income, that is, on what basis do we tax the basic salary? Basic salary, we all know, is the foundation or the base on which other calculations are made with respect to computations. If we say DA is 24% or 30% or 5%, it's percentage of what? It is percentage of basic. Contribution to PF or National Pension Scheme or valuation of any of the perquisites is always done as a percentage of basic salary. So we need to be very careful about knowing as to how do we compute basic salary. As we have just discussed, basic salary is taxed on the basis of due or received. If it is due prior to receipt, let us say salary for the period of March. We are talking of financial year 2021. You must have done this in your basic concepts. Salary for March becomes due in March, but if you receive it in April, that happens to be the next year. But it will be taxable in 2021 only. Why? Because you have got the salary due to your credit. And similarly, as discussed, if you receive any advance for the next year, this year, that would also be taxable this year because it is taxable again on the basis of receipt prior to due. The only exception that we have is related to arrears. Arrears are taxable on receipt basis. So if there has been any retrospective increase in your salary, let's say for 1920 or say 1819, and you receive a lump sum amount of say 50,000 in the year 2021, that 50,000 would not be taxable for the earlier years because the increase itself has been announced in subsequent years. So arrears are always taxable on receipt basis, though however, the employee gets the benefit of exemption or say the benefit of relief on arrears under section 89, where you can appropriate your arrears to earlier years, and if you happen to get the benefit of tax by being followed in a lower rate of tax, the employee can get that benefit. Now, we can understand the concept of basis of charge on the basis of this example. Say, X joins a company on 1st July 2018. There is a pay scale usually over which the appointment takes place. And the pay scale is say 20,000, 3,000, 60,000. What does pay scale mean? Pay scale means when you join your job, you are starting your salary at the basic point of 20,000. Every year we get an increment and we continue to get this increment till the point we reach the higher level of the range, which is 60,000. And the increase every year is the increment of 3,000. So 20,000 increased every year by 3,000 continues till you reach 60,000. Now on the pay scale also, salary either becomes due on last day of the month or it becomes due on the first day of the next month. Now there is a little difference in calculation of basic, so we have to be careful about calculating basic if the question says last date of the month or if the question says first day of the next month. So for assessment year 21, 22 with this information of 20,000, 3,000, 6,000 and joining date being 1st July 2018 for previous year 2021, what shall be the basic salary of X? Let's understand this. 1st July 2018, X joins at a basic of 20,000. That's what the question says. 1st July 2018, you join at a basic salary of 20,000. Every year on the same date, 1st July 2019, now your basic goes up to 23. Then 1st July 2020, it will go up to 26. And 1st July 2021, it goes up to 29. That is what this 3,000 means, that every year to your basic, there is an increment of 3,000 rupees. Now, since our previous year is 2021, we need to know the basic for the year 2021. Now, what is this basic for 2021? April 2020 to March 2021. Now, April 2020, what is the basic? There is an increment on 1st July 2020. So, when there is an increment on 1st July 2020, it means his basic on 1st April 2020 is 23,000. That continues till before 1st July. So, April we have 23,000, May we have 23,000, June we have 23,000. So, for 3 months, April, May and June, the basic salary is 23,000 into 3. And July 2020 to 31st March 2021, because next increment happens in July 2021. So prior to that, from July to March, so that makes it 9 months. So for other 9 months, his basic will be 26,000. 1st July 2020 to 31st March 2021. And that makes it 26,000 into 9. So what do we have? 23,000 into 3, April, May, June, plus 26,000 into 9, that is July to March. So his total basic salary would be 2,34,000. So that's the starting point of calculating salary. 2,34,000 for the second period and 69,000 for the first batch, and together his basic would be 3,03,000. Now, whatever computations we have to further make on this basic, it will be a percentage of 3,03,000. This is the way we calculate basic on a pay scale. Usually we do not have a pay scale. The question may say simply, his basic is say 20,000 per month. So we simply say 20,000 into 12, that's our basic. But if we are given a pay scale, Then this is how from the scale we arrive at one single figure for the basic salary. If we do not have a pay scale, fair enough, we'll just take the figure as it appears in the question. Now this is how we compute basic if we are given that salary becomes due on last day of the month, because April becomes due in April, May in May, June in June, and till March, salary of March becomes due in March. So there is no shifting of March to next year or bringing up of the earlier year's March to this year. However, if salary becomes due on first day of next month, then we are faced with a little bit of a tricky problem. Why? Because when we are saying first day of next month, that means for the last month of the year, March, the salary becomes due itself in April. So when the salary becomes due in April, naturally you will be receiving it also in April. And April happens to be the next year, 21, 22. So what happens is that while the earlier case said 26,009, here this becomes 26,000 into 8, because the salary of the March gets shifted to next year. It becomes due in 21, 22. Similarly, salary for March for the earlier year, 1920. As salary for the March 2021 goes to 21-22, similarly salary for 1920 comes to 2021. So, while in this case it was 23,000 into 3, this becomes 23,000 into 4. Right. So, if it becomes due on last day of the month, this would be 23,000 into 3, April, May, June. If it becomes due on first day of next month, then March for the earlier year would be included and March for this year would be excluded. So that becomes 92,000 plus 208, that is 3 lakhs. So see, if salary becomes due on last day of the month, the basic becomes 3 lakhs 3,000. But if salary becomes due on first day of next month, the basic becomes 3 lakhs. So you have to be careful if basic salary is given as a scale of pay. As a scale of pay, first day of the next month causes a little bit of caution at the part of calculations, but if it is last day of the month, it's comparatively simpler. The next component is your retirement benefit, leave salary. Now, what is leave salary? Leave salary means the salary for the leave that you have not taken for the period of service that you have given to your employer. We have a variety of kinds of leaves. Say casual leave and say earned leave. These are the two basic kinds of leaves that one talks about. Now for casual leave, what happens if your entitlement is say 10 leaves in a year, and end of the year you have taken 8 so that you are left with 2. Next year again you have 10 leaves. Now this remaining 2 expires at the end of the year. Next year your leave would be 10. You will not get 10 plus untaken part of leave, unclaimed part of leave for the last year. But when we talk of earned leave is the leave that you earn while you are in service. So say for 1 year of service, for your first year of service, you are entitled for 2 months of leave. And say you have worked for 40 years. So when you have worked for 40 years, how much of leave have we earned? We have earned a leave of 80 months. For 40 years of service, at the rate of 2 months for each year, the leave entitlement, we call it as leave entitlement. Your leave entitlement is 80 months. Now, you may also have taken some leave while in service. So, leave taken, let's say you have taken 30 months of leave. So out of 80 months, you have taken 30 months. And leave salary, earned leave is something that gets accumulated. In the first year, let us say your entitlement is 2 months and you take leave for 1 month. So next year what happens? Next year you have 2 months again for the fresh year. In addition, we add the leave that is still pending for the last year. So your leave becomes 3 months. Similarly, next year you have another 2 months, and to this 2 months, if in the second year you have not taken any leave, so you have 2 months plus 3 months. Together you have now a period of leave to your credit equivalent to 5 months. So this leave keeps on accumulating. Untaken leave keeps on accumulating, and say by the end of your service of 40 years, on this basis of 2 months, your entitlement is 80, and whatever you have taken over the period of this time, you have taken 30. So now you leave due at the time of retirement. We call it as leave due to your credit at the time of retirement. This is 50 months. So how have we arrived at this 50 months? 2 months for 1 year, that makes it 80. Leave taken 30 during your service period of 40 years. So leave due is 50 months. Now this 50 months of leave shall be multiplied by your salary, and what you get is called as leave salary. So what is leave salary? Salary that you get for the period of leave that you have accumulated over your service period. That is the leave that you have not taken during your service period. And most of the employees actually do try to accumulate this leave. Casually, if it expires, it expires. So normally, employees do try to utilize the leave by the end of the year. But earned leave, employees usually try to accumulate. It's up to 300 days of leave. If you have 300 days of leave to your credit at the time of retirement, which is what? 30 months. So you get cash for 30 months at the time of retirement. So that 30 months of cash is called leave salary. That is the meaning of the term leave salary. Right? Now, how do we tax it? We can have encashment of leave while we are in service, and we can also get the cash at the time of retirement. Usually people try to accumulate, as I said, to get the cash at the time of retirement, but if you need it during service, you can get it during service also. But when you encash it during service, this amount is fully taxable. You need to pay tax on this. If you get it at the time of retirement, then there is a difference in computation depending on the nature of employment. If you are a government employee, this leave is exempt. This encashment is exempt. But if you are a non-government employee, we'll take a little time in understanding how to show the exempted amount of any component of salary, because once leave salary is clear, it will be easier for you to understand how to present the exemption on account of any either retirement benefit or any allowance. So, for computational purposes, what do we do? How do we present? Say, we have basic salary. We have basic salary of, let us say, 10,000 into 12, so that your annual salary is 1,20,000. You get allowances also. We are trying to keep the question simple. We have DNS allowance. Let us say DNS allowance is 1,000 per month. We are taking simple calculations just for the purpose of understanding. Now your DA is 12,000. You may also be getting commission. Commission on purchases made by you. Commission on sales made by you. You could be getting commission either as a fixed amount or you could be getting commission as a percentage. Let's say you get both. You get a fixed amount of commission of 5,000 and you also get commission as a percentage, say 1%. Let's say 1%. 1% of what? 1% of sales, which we call as turnover. So you get commission of 1% of turnover, not on purchase. You may get commission on purchases also. Let's say you get commission of 1% on purchases also, which happens to be 6,000. Never mind. All this gets added to your salary in order to compute your gross salary. But for the purpose of leave salary, we need to consider certain things and not consider other things. So 1% of turnover, let's say your turnover is 1 lakh. You have achieved sales of 1 lakh. 1% of 1 lakh would be what? 1,000. Now what all have you earned in your salary structure? You have a basic salary of say 1,20,000. You have DA of 12,000. You have fixed commission of 5,000. You have commission percentage of turnover 1,000 and you have commission percentage of purchases, say 1%. You're getting all this and therefore all this together will be very much a part of your taxable gross salary. But if you say retire, let's say you retire on 31st March 2021 and you get a leave salary of say 4 lakhs. On this leave salary of 4 lakhs, we shall give some amount of exemption. A part of this leave salary is exempt. And to find out this amount of exemption, we follow a rule. And the rule is, we find 4 figures, 1, 2, 3, 4. And the least of these 4 would be the amount of leave salary exempt from tax, which we shall show here. And the balance would be taxable as leave salary. So how do we find out the amount of exemption? We have 4 things. 1, cash equivalent for the period of leave due to the credit of employee at the time of retirement. This equivalent is calculated on the basis of 30 days of leave for each year of service. We do not take the actual entitlement if it's more than 1 month. We consider it for 30 days. 2, we take 10 months of average salary. 3, we take amount specified by the government, which is 3 lakhs. 3 lakhs means what? 3 lakhs means you cannot claim exemption of more than 3 lakhs. Why? Because if 1, 2 and 4 happen to be more than 3, 3 comes out to be the least. So exemption would be 3. Right? And if any of these figures are less than 3, then the lesser amount would be exempt. So any fixed amount means maximum amount of exemption, and this is a lifetime exemption, not per job exemption. So if you have been changing jobs and getting exemption on account of leave salary, then for any earlier exemptions that you have claimed, this 3 lakh constantly gets reduced by that amount. So in this particular case, leave encashment actually received. How much has he actually received? Let's say we have point number 1, we have 2, we have 3, we have 4. So actually received we have here. Actually received is 4 lakhs. Then let's say government has specified 3 lakhs, so we take 3 lakhs. But if any amount has earlier been claimed as deduction, let's say you have already claimed 50,000, so now this 3 lakh becomes 250. So it depends on the information as presented in the question. Then 10 months of average salary, which means we need to multiply 10 by average salary. And what do we mean by average salary? Average salary means your basic salary, your DA. DA is conditional. Conditional means if it is a part of salary, then we take, otherwise we don't take. And we have commission. This is also conditional. If it is a percentage of turnover, we shall consider, otherwise we shall not consider. So here, basic salary 10,000 per month. We will take basic. DA, part or not a part? As a part of your gross salary, DA is always taxable, whether part or not a part. But for computing certain exemptions, we shall consider DA only if it is a part of salary. So while we have to calculate average salary here, we'll take salary if it is a part of salary. DA if it is a part of salary. So to keep the understanding simple at the moment, let's say it is not a part of salary. So your basic is only 10,000. And how much of commission shall we take? As much as is a percentage of turnover. We need to know these points. Average salary we have to take for 10 months. 10 months multiplied by what? 10 months multiplied by basic for 10 months, DA for 10 months, conditional, commission for 10 months, conditional. So, what are we doing here? We have the basic for, let's say 1 year. Let's say for 1 year, we have a basic of 1,20,000. DA we do not have. Why? Because DA is not a part of salary. And then we have commission. Fixed commission we shall not include. Commission as a percentage of purchases we shall not include. Commission as a percentage of sales we shall include. And this is 1,000. So what do we have? We have 1,21,000 as your salary for 1 year. So we want it for 1 month. So we divide it by 12.